I'll be your host for now. My name is Juanis Barredo. I'm the head of the technical analysis department. All right, so people coming into the world of trading is really very key in trying to be able to put together an appropriate plan. Dealing with money is very emotional, and if you want to be able to make sure that you are putting yourself in a condition to buy and sell stocks appropriately, then you would have to have the discipline or a plan of activity before getting into this type of market. Now, the discipline really involves trying to be able to put yourself into a condition to buy and sell. And you would have to be able to have a plan of action of doing that. You cannot just wake up one day and try to be able to just say, I feel like doing this or I feel like doing that. An investor is somebody who would come around to be able to buy stocks for the long term. And they would be geared to be able to do that. Just buy companies, no need to time anything else. And they would hold it over time, assuming that the company's prospects would do well. A trader, however, is someone who is much more fixated in making sure that the battle plan of doing that is down and very, very precise. He will try to be able to acknowledge the fact that buying shares of stock will happen only on set circumstances, and anything that comes out of those circumstances, they will not try to be able to deal with. If it's time for him to move in and time for him to go out, then he follows all the necessary trading rules to be able to do that. Now, when we come around to be able to move into the world of trading, the very first thing we have to do as a first step is really to be able to evaluate the big picture. What's going on in world markets? Are things looking good? Are things looking bad? Are we in a very, very bullish sentiment period where prices are continuously moving higher? The economy is doing well. And if we are in such a case, then it's easy for you to become very aggressive. You can buy stocks very aggressively. You don't have to be able to wait over time. You can go ahead and start position well in many of the companies that are doing well. But if we are in a period where bearish sentiment or declines are taking place and we have corrective activities, then you would have to be able to stand back, let markets try to be able to pull back first before attempting to move into the market. Take your time. You don't need to be able to flush things right away because the market is not in your favor anyway, and you might be able to get a better opportunity to buy stocks at good prices. An example of looking at that would be something like this. If you look at the environment you see in a picture of the graph you see here, we have one where you see a very, very strong bullish sentiment movement where stock prices are moving higher. Uh, Traders can be very aggressive buying and holding stocks because they can see that the forcefulness of the advance is very much in place. And if you notice, pullbacks in prices are very minimal in such cases because a lot of people want to buy and their ability to hold on to the stock is very, very solid. But there will be circumstances where you might see a bearish scenario, such as what you see here. Prices are moving down. People don't know what to expect in terms of the economic reality. They probably see prices falling down fast in certain cases, and that is causing some edginess into the market. So, in circumstances like this, you want to take more defensive tactics rather than being more aggressive. Allow prices to come back to lower prices. Take your time buying. You don't have to be able to put too much money out on the table right away. You can gradually buy this market as it continues to dip. And this is the kind of situation you want to do when you begin because you don't want to be coming saying too aggressively in a market that's doing too weak. Or you don't want to become too defensive in a market that's too strong. It might leave you behind and you might not really be able to ride on that horse, so to speak. Now, another thing that we all have to qualify, and this is really pretty much stemming from what our head of research was talking about earlier, is you have to make sure that even though we do trade stocks, we want to be able to trade stocks that are of good quality. These are fundamentally sound companies that are generating good business, and they should follow a certain degree of qualification when you pick them. We like to know companies that are doing well and know what we like to call it looking for gems into businesses. When we say looking for gems, we want to find companies that are in a growing industry, companies that are showing us good earnings visibility, companies that also show credible management. That means that in good or tough times, companies can still generate good amount of money. These companies also have superior products and services. Maybe they could have a service or product that you cannot do without, or it could be something that is very, very much lasting, and no matter what happens, their product remains to be one of the top sellers inside an industry. And finally, the last S supports the conditions of a strong balance sheet. The company must have an ample amount of money to be able to do things like acquisition in case they need to, or they might be able to need the capacity to be able to fend off some of the debt that they also have. And all these company ingredients all together really make one fantastic company to own over the long period of time. If you can find companies that have 4 out of 5 of these gems, these are the kind of businesses that you want to focus on in your trading ability. Now let's talk about uh, pricing. One thing that also I presume that April talked about really is that companies have a particular value that you should understand called fair value. The fair value of a business is what a company is said to be worth. And what you want to do as a trader is that whenever you enter into a stock, you want to be able to buy these companies below their fair value or below at what they are worth. That way, if you buy it at a discount, it has room to go up to the fair value and enough room for you to make money. If you end up buying at the fair value or higher, your prospects in the short term of making money is not very good because the company is already trading at the value that it's supposed to, and the amount of upside that you might get will be limited or might not last too long. So try to be able to get into the habit of trying to buy cheap companies where you can buy and accumulate prices at a very good, solid valuations. Okay, so coming into the hand of choosing a certain type of investment strategy, we want to be able to focus on just a few things and choose from maybe 1 or 2 of these particular type of strategies to uphold. Now, commonly, there are 2 basic trading strategies. We have what is known as a buy and hold strategy. That means that you would be just simply buying it all one go and then holding it for a lengthy period of time. No need to be buying and selling in the interim. You will only end up selling that one day when you need to. And the second type of investment strategy you can actually choose is what we call trading. And trading is all about understanding market timing, and you will be using trends to be able to distinguish what the trends are and to be able to take advantage of it. Later, we'll talk about trend trading, and then we'll talk about range trading. Okay, we'll start with the first strategy called buying and holding. Now, this type of strategy is, I guess, the most simple. All you're going to do is look for a company you really like, and you're going to be purchasing this company and you're going to be holding this business for a very long period of time. These particular companies are very solid, and hopefully they have a value proposition that you can see that will stem for the long term. So, for example, if you were to buy a company like Meralco or Bank of the Philippine Islands or Metrobank, these are businesses that are very solid. You don't think these guys are going to be ruining their business anytime soon. And you'll probably see them much of the leaders in their particular industry in the next 3, 5, 10, or 15, 20 years. And these particular companies can just be bought even if you had a pretty big amount of money. Leave it in there and ride your way through the volatility that may come. But I think over the period of time, you should be able to do well in doing this. The advantage of this is it's easy to implement. You really don't have to do any timing involvement. It's also very efficient in terms of cost because you will be buying it once. You will not be buying and selling it multiple times, which could incur a lot of fees and charges on the guys. And that means that it's very, very easy to be able to put off. The disadvantage of this is it's open to heavy losses because if you buy a stock and you just hold it for a lengthy period and the stock price attempts to come down for some reason and you continue to just hold it and hold it, then of course certain things may happen along the way. And it becomes very subject to your risk tolerance. That means will you get scared as prices will be falling down? And hopefully that you don't. And as long as the business maintains the good quality sense of what it does and continues to produce good income and growth stories, you should be able to keep yourself in there. The other disadvantage of a buy and hold strategy is that if you keep your money in that one stock and you hold it through and through, and another opportunity comes, you might miss out on that particular opportunity, especially if your stock happens to be going sideways and another stock starts to move up and you don't get to be able to participate with that one. Now, going deeper into the buy and hold strategies can be divided into 3 different types. The first one, and a very popular one, is what we call a one time, big time investment strategy. That means you're going to get all the money that you have that you want to be able to use an investment, and you're going to put that into the market all in one go. Now, nothing wrong with that. And let's assume that you probably enter the market, let's say at this point in time, when you're buying kind of near the low of a situation, and prices had gone up, gone down, and go back up, and you've managed to be able to withstand some of the choppiness of the market to be able to make money in the end. Now, what happens if you buy the market at a high point? And if you buy the market at a high point and you see prices coming down, your portfolio turns red, and every day you see it turn red as prices continuously move lower, that will make you question what it is that you're doing. A lot of doubts will come inside, and your holding ability is very much challenged during that time. And once you have that conditions and you see prices start to fall down like this, then you will have to be able to see whether you can hold your stock position during that time, or will you let go out of frustration during that period. So I know it's a very, very difficult thing to try to be able to put somebody through, but this is one of the disadvantages when you get when you do lump sum trading. The advantage is, again, it's easy to implement. There's no need to time the market, efficient in terms of costs and fees. And the nice thing about it is that you can put all your money into activity right now. The disadvantage is, again, you're prone to heavy losses, subject again to your risk tolerance, miss out on other opportunities that I discussed earlier. And the disadvantage of this one is if you don't have a lot of money immediately, there is no way for you to do a lump sum investment because you will have to earn your money little by little over time. And so, if that is the way you are attempting to be able to get your capital, then I would suggest looking at the next type of investment strategy. Now, the next type of investment strategy we have is actually a very, very good one. This is called cost averaging. Now, cost averaging entails you buying your share of stock gradually over a period of time, but you're going to fix the peso amount that you're going to be inputting into your particular investment. Let's say you decide to invest 5,000 pesos every month for the next 1, 2, or 3 years. That's an example of a cost averaging strategy. And you should not fall apart from that particular strategy when you if you say 5,000, then you put 5,000 pesos worth. If you decide to break your 5,000 into two and you say 2,500 to buy shares in BPI or 2,500 to buy Ayala Land, then you will fix that strategy and move it over and over. Now, you can alter the plan in terms of you attempting to do this either in a monthly period or a quarterly period or even a semi-annual period. And just make sure that the amount that you decide to choose is something that's very comfortable for you to carry on. But we don't want this you to be very erratic in your movements of prices because our objective over here is to be able to catch a market that sometimes might be choppy, similar to what you're about to see here. Here's an example of a price movement of a company, a good one. And you would see that prices are quite volatile. They'd be moving first from 3 pesos to 5, then back closer to 3, then back a little bit over 5. And over time, you will get a very volatile swing. Now, here's an example that's very difficult because it's very hard to predict such movements in the stock market. And so, because we cannot predict it very, very exactly, what we would do is we'd simply buy gradually over time and hope that we get a good average price for that entire period. If you were to follow the previous strategy, you're buying 5,000 pesos every month, then your average cost of buying all the shares will look something like this. And that blue line that you see will tell you what your average cost for buying all those shares are. And the reason you would notice that your average cost would be dropping in the lower end of the band is because as you start buying gradually over time, whenever your 5,000 pesos attempts to buy a company's price and it's at the lower band, you will be able to buy more shares. If you move over and see that there are high bands in those prices, your 5,000 will be able to buy only a fewer number of shares. And this is exactly the result you want. When prices are low, you buy more. When prices are high, you buy less. And as you would see, by doing that over a period of time, the blue line suggests that your average cost drops to the lower end of the band. And what more if you carry this off over a good period of time? So this is a very, very good strategy to work off, especially for those who are just starting their investments. Now, there is one more type of strategy that you can do. I call this cost averaging with a twist. And the reason is because we will follow a basic cost averaging strategy. The only thing is we will add a little bit more flexibility here. We will take into account the fair value of a company when we do this. Now, the way it would work would be you continue to buy your 5,000 pesos every month, but you will only do that if the price of your stock is either below the fair value or even better, if it is below a certain percentage of your fair value. That way, you're buying companies at a discount. And all that means that if that price band were to swing up and down and you get an opportunity to buy the company below the fair value, then you continue the cost averaging strategy. If ever the stock price goes above the fair value or way higher than fair value, you stop buying. And some people might even think of selling if it were to go in there. This actually turns out to generate much better profitability than the regular cost averaging strategy because it allows you to take advantage of certain market swings. But this is already a certain type of trading that you're already getting into. And if you want to be able to get into deeper trading, we will just suggest a different type of strategy that you can come around to be able to do. The second type of strategy we'll talk about today is timing markets. Now, timing markets involves looking at trends into these particular markets, and if we can take advantage of such trends, we should be able to make more money in this particular prospect. If you have a look at the image you see here in the middle, you will see the price of a particular company, and you would see that this was a movement that moved from an uptrend to a sideways trend and into a downtrend. And in that particular strategy, we have to alter what we will be doing depending on the particular trend that you encounter. In an upward moving environment, we can be aggressive, we'll be buying on the lows, and we'll be holding our position. When prices move sideways, then what we will do is we will try to buy in the lower end of that price and sell it at the high band of that price. When prices are moving down, we will try to get ourselves out of a situation and stay out of the market while it continuously goes down. And we will wait for this market to bottom out or to be able to turn its way out of that decline until it can show us it can start to move again. Now, ideally, in this method, you can actually make much, much more money. The only thing about this is that, of course, there is a lot more education that's necessary because you can't do this instinctively. So the advantage is you can take a market perspective. That means you can understand what's going on, which way is the market going if you start to study how to be able to look at markets using timing. You can tell about trends, you can take advantage of such trends. If the market is turning down, you can sell your stock and you don't have to be able to bleed off too much. And the last advantage you would get is that in case prices do intend to be able to head downwards, you can cut your particular position down in half or lighten up severely so that the impact of any decline that would come inside will not hurt you too much. A disadvantage, of course, of this particular type of trading system is one, you have to study more and you have to be able to practice. This is quite a little difficult to be able to learn over time. But if you have the patience, skill, and discipline, this is a phenomenal type of trading system that anybody can actually learn. Second is it's also subject to interpretation. I would have to say that after so many people that I have trained, many of them still today will have different opinions despite the same graph that they would look at. And so it is very much subject to that type of interpretation. And that's why, of course, a meaningful amount of experience is necessary to be able to capitalize on this. And the last disadvantage of it is just in case you call the trend wrong, you might miss out on any other opportunities that might come into the long term. And that's why, of course, if you go into the world of technical trading or technical analysis trading, you would have to be able to learn a little bit more and practice and perfect your system. Okay, so what is technical analysis anyway? Now, technical analysis is a study of the movement of price of anything, of stocks, of bonds, of commodities, or currencies. And we will look at prices in graphic form, and we'll put this day after day so that it will produce a price chart for us. We will look at the price chart because we want to see how prices trend off in time. And after we spot and follow these particular trends, we will know what better to do in terms of our investment strategies. Now, there's two common ways of looking at prices in a graph. There is what we call a bar graph and what we call a candlestick graph. The two of the types are displayed in the bottom of your screen. Now, we will plot out these points, the open, high, low, close price points of every day of companies. And as we portray that into day after day, then you will see an alignment of a particular trend that will surface from them. Here is what you would see if you were to put one day of trading after another. This is a particular type of market that's swung quite in a very volatile fashion. But one thing you should be able to understand is that markets can only show you one of three trends. Either it will go up, either it will go down, or it will go sideways. Our job as a technical analyst is to be able to determine which way the market is heading. In this particular example, you would see a market that's moving higher. An uptrend like this is gauged by seeing higher highs in price and higher lows in price. In this example here, you will see a market heading downwards, where the highs of the graph are getting lower and the lows of the graph are getting lower. This is how we distinguish one trend from another. So remember, in an uptrend, you have a higher high followed by higher lows in price. In a downtrend, you have lower highs followed by lower lows in price. Anything that falls outside of those two types of definitions of a trend is what we call a sideways market. So a sideways market is simply a market that's moving horizontally, which could be slightly pitched upwards or downwards, but that tells you that prices are only moving within a set band. Once you determine what the trend of a market is, your strategy should change depending on what trend you're looking at. Now, when a trend attempts to be able to put itself together, it would move itself from one point to another. If you look at the particular images you see in the middle of the chart we have here, you will see an image where you would have 2 points that prices seem to be moving up and down between. We have an area of support and we have an area of resistance. Now, the low points of a graph suggest an area of support. When we talk about an area of support, we talk about an area where buying is very intense. It is very heavy. There's a lot of demand for people who are trying to buy at that particular price, and it's the reason why prices don't want to fall down anymore. And it provides lift, it pushes prices upwards, and that's why we call it an area of support. The opposite of that is an area of resistance, usually drawn by the tops of a graph, and these areas express areas where there's a lot of heavy selling taking place. People who want to take profits in their stock positions or feel that the price is right, and they're liquidating their companies every time prices move into this particular band. So instead of having to keep saying tops and bottoms, we'll call these areas support and resistance as we come around to be able to look at our capacity today. If you notice in the first image, support and resistance seem to be horizontal. If it moves into a condition like that, one trading idea for you to be able to use in your system is to be able to buy your stock prices at the lower part of that price band and to be able to sell it when it goes on the upper band. If ever you find an uptrend like the one you see on the right side, your support and resistance areas seem to be moving higher along with the price. And so what you do is you try to be able to realign your particular support and resistance line upwards as well. And so whenever prices continuously move down, you want to be able to be buying it on the lower end of the band and of course sell it whenever it comes towards the higher end of the band. And that's what we would use as a basic trading strategy using this system. Now, when we follow trends, we want to be able to use a particular tool so that we can tell us whether the market is still moving upwards or whether it has managed to turn. If you look at the example we have in this price chart we have over here of Metrobank, I will draw a particular trend line so that you can see how it works well. If you notice the left part of your graph, you will see a particular uptrend that will begin, then it turns and it starts to head downwards, and then on the right side you will see it turns again and it starts to move upwards again. The blue lines you see drawn are what we call uptrend lines. They're drawn by connecting the low ends of the graph. The red line you see is called a downtrend line, and a downtrend line is drawn by connecting the tops of your graph. Please try not to be able to do the opposite. You do not draw a downtrend line by connecting the lows of a graph, and you do not draw an uptrend line by connecting the tops of the graph. The reason an uptrend line is drawn by the lows is because you want to be able to connect all the areas of support to tell you which way the market is heading. That is an area where buying is very heavy, and you want to be looking to buy closer to where that blue line is rather than prices going way too far above from it. When prices turn and they start to move downwards, you want to be able to make sure that you sell your particular position whenever prices attempt to be able to break such points like this. So when you see prices moving back down and they're breaking the blue particular point, you liquidate your shares of stock first because a trend change is taking place. You can always buy your stock back whenever you see prices moving back higher and an uptrend is finally registering itself again. Here are examples of good buy periods. So whenever prices bounce off your support of your trend lines, that is a good place for you to be buying your stock. If ever you see prices are way above the blue line, you wait. You don't enter your stock there. You wait for prices to come back down, allow them to bounce from your blue line, and then you enter when you see these bouncy movements taking place. You will sell your stock position when you find that these blue lines are broken. Now, when you buy your stock inside an uptrend, you will attempt to hold on to it as long as you can. The only time you have a signal to sell is when the uptrend line is broken. If they do not break, you should not sell. Now, You've noticed that as prices are moving up over time, there are periods where it can be quite excessive. And such excessiveness into a market is something that we're going to have to deal with. People put their emotions into play. Whenever they're buying stocks and their stock prices move up or down, they get a little bit emotional in the situation. They tend to aggravate the price. Now, the blue line you see here is an example of an uptrend line. If prices could follow that line all the way up, people should just hold on to their stock and not sell. But if prices attempt to be able to move faster than what that trend line is showing you, as you see over here, eventually the market's going to have to pay for that. And it will have to pay for that by going into what we call a correction. A correction could be able to put some downward pressure into prices or put it into a sideways motion. The two examples of corrections are drawn in this green dotted line as you see there. The first type of a correction is what we call a correction in price because prices will have to move downwards to be able to fix the problem. So when prices are moving way too fast, people will get quite eager to be able to take some profits, and that profit taking will be able to push prices down. If the price is very, very strong, the corrective process could actually simply go sideways. This type of correction is what we call a consolidation in time. But either way, if prices move up too fast too soon, there will be a need for prices to be able to correct and either go downwards or go sideways. Remember again, when you want to be able to buy your stock at a good price, you want prices to come back down to your trend line, and you want to be buying closer to this area of your trend line rather than buying too high from the price of your trend line. Here's an example of a price movement. This is First Philippine Holdings some time ago. And if you were to look at it, it's moved up quite choppily. I will put a trend line here to be able to show you the wisdom of what we looked at earlier on. Here is a trend line. And if you notice the trend line that we put inside there, you will notice that there were moments where prices have moved up and they've managed to be able to scale lower. Every time the price moves back down to your trend line and bounces up, these are good areas for you to be able to buy. In fact, these are perfect entry periods for you to be able to accumulate companies whenever they go around. If you notice on the top end, these are the areas where you're not supposed to buy because these areas have shown a very, very rapid upward move in price, and you would want for prices to be able to wait to come down before anything else. Now, whenever corrections come back down, it'll the only strategy you would use is to be able to buy prices off the bounce. But if however prices move sideways and we go into what is known as a correction in time, then you would have to be able to assume that prices may have to be able to move zigzag upwards and downwards inside a set band for a while. These are what we call consolidations or area patterns. And this is how a market sometimes needs to rest. It's just like a basketball player who starts to play a very hectic game of basketball, and eventually he's got to go through a pit stop moment and rest to be able to get his breath back. Well, markets get tired too. And as markets attempt to be able to get tired, they go sideways in their capacity to rest. Now, while they're resting, there may or may not be an opportunity for you to make money along the way. The whole idea is to be able to buy it at the lower end of the range or buying it on support and to be able to sell it whenever they move towards resistance. We call this trading strategy a range trade strategy. The only time we would change our strategy to buy low and sell high would be if prices manage to be able to push out of the area pattern range. If you see on the first example, prices are breaking above the resistance area, this might be a good strategy for you to be able to buy. We call these a breakout moment. And these breakout moments usually come around to show prices moving very, very forceful upwards. Think of yourself looking at a Coca-Cola bottle and you are shaking it up and down, and on the last moment you're releasing the cap and you get a very, very short, very, very strong flush out of the water going up. This is the same similar type of pressure that you will get in a situation like this. But if you were to turn that upside down and you would get the same type of shaking, and then prices were breaking support instead, the lower area of the range, and if it were break down here, and you would get a massive amount of selling that will come, and your stock price will actually fall quite deep. We call this a breakdown situation. So if prices break support, you sell. If prices break up above resistance, you buy. And try to be able to keep this in mind because movements out of this particular range are usually very fast. And you can actually make very short term money very quickly if you can take advantage of these particular types of trades. Now let's try to apply what we just learned there in terms of some examples we have today. This is the most recent graph we have of Jollibee Foods Corporation. The company, for the better part of 2013 2014, have been doing very well. An uptrend has been sighted, and you have the ability to see that the trend line over here was intact. However, sometime this year, we've noticed that prices managed to be able to flow downwards. And so here is something that we're going to have to take extra precaution about. But let's look at what happened in 2013. There was a moment inside where Jollibee was moving quite stronger upwards, and then we saw the price of Jollibee move down a little bit lower, bounce down its trend line, and then attempt to be able to move back up. So this strategy, when we see this area over here, would be a good time to be able to buy your stock. It puts prices back into major support. Prices are no longer moving up too fast too soon, and they manage to normalize their curve, and it becomes a very good point for you people to buy because support has now been met, and it will make riskiness actually very, very slight. Now, there is an area over here that takes place in 2015 where the price of your stock manages to break below the trend line. This is a breakdown moment. And as we suggested earlier, it's a good time to start selling your stocks first. As the trend of the stock is moving from an uptrend, perhaps could be moving into a sideways or even a downtrend as it is suggesting right now. And as prices continue to be able to keep itself into a downtrend, you should be waiting patiently for the next opportunity to buy, but not buying while this thing is falling down. As long as that red downtrend line is in play, you should stay out of that particular stock, look for another issue that is uptrending, and keep yourself in that issue instead rather than staying into this stock. Another example we can have a look at is Metrobank. Now, Metrobank was also moving back into an uptrend, and for the good part of 2015, equally so. However, just recently we've noticed quite a bit of shakiness taking place in the price, and you can see that prices managed to be able to crack a little bit from the uptrend line that we looked at. Now, there are moments, however, also in its history where prices managed to go up very, very quickly, and you would see moments that it would push itself back down to the trend line, recover again, push itself back into the trend line. And again, in 2003, a very, very, very strong up move was also very, very much seen. And despite that, prices also were pushed back down to the trend line. So you would see that there would be moments where consolidations would take place into Metrobank. And if these consolidations are seen by you, it will also be a good time to be able to buy at support and sell your shares at resistance. Again, buy your shares at support somewhere here in 2014, and of course sell it whenever it would come into the high end of the range. And all we have to do inside looking at trends in markets is checking. Are we in an uptrend or are we not? If we are in an uptrend, you buy at support and you hold your stock. If you are now in a sideways market or a consolidation and in an area pattern, then you would buy low and you would sell high. And since we can see in the particular prospect of Metrobank in this case, there seems to be a turn taking place as the uptrend is being challenged, and you can see that the previous high was very flat, and more likely there is a capacity for prices to move between about 85 or 83 where it is now, and could possibly even go down to somewhere closer to 70. If it does that and it bounces from there, that might be opening up your next opportunity to buy Metrobank. The final example we'll look at today will be applying that particular trading philosophy in the Philippine Stock Exchange Index. The PSEI index has been quite formidable. Since 2009, it's been climbing up in a very, very aggressive uptrend. However, today, the price of the particular stock is currently testing the lower end of that particular trend line. And at about 6,900 or 6,800 is exactly where that range would be. And we have to be able to watch very carefully to see what happens to this particular index now that it's testing the support of the trend line. You would also notice that there were consolidations that took place during various times whenever prices went up too fast too soon. And the corrections that it managed to be able to do is to be able to allow it to go back down to its trend. If you notice, the next one we saw in 2014, prices managed to be able to come back down also to the support of its trend line before moving up again. So now we are in a crossroad. We're looking at prices come towards your index trend line. If this index trend line breaks, then it may be able to announce that the market may need to be able to pull back even deeper. It might move into a wide sideways range, and this is more likely that could happen because of the slowdown we've seen into economic growth into the Philippines, as well as the challenges we've been seeing in various countries, like, of course, a slowdown in China and the impact of devaluations caused by Asian currencies, and perhaps the potential increase in interest rates that may come from the United States. So these are the things that you would have to look at in terms of a trading concept and trying to be able to apply that into these circumstances so that we can try to be able to engender asking ourselves when is the better time to buy, when it would be the better time to sell, should I be aggressive or should I be defensive? And all of these are made back by the trends that we're looking at. The final stage of our talk today is really about execution. Remember, planning is just half the equation. The actually doing the transaction that you're supposed to do is a little bit more difficult. And the reason for that is because our emotions get into the way. Now, I cannot stress the importance of putting that plan out in front of you. You have to be able to stick to it. You have to be able to follow it. When it's time for you to enter, you enter. When it's time for you to liquidate because your support ranges are breaking, then you liquidate. Now, we don't do this because we don't want to make money, but we do it because we want to make more money and we want to be able to lessen the amount of risk that we take. And it's very important for you to be able to try to be able to look inside you and ask yourself whether you can go ahead and follow those plans because your money is involved and sometimes you might chicken out on some of the plans that you do. Now, remember this: right mind, right action. If you have a very troubled mind and you're constantly challenging your plan, it'll be very difficult for you to be able to move into the world of trading and follow it with good discipline. A trader's hand, as itself here, is like crafted like a sword. You have to be able to pummel it. It has to be heated, hammered, folded, and cooled eventually. And that way, your trading prowess will become very much stronger. Three things to remember: always have a trading plan. You cannot just wake up one morning, open your computer screen, see what prices are doing, and execute a trade. Right? Nothing comes out of that. Understand when it's time for you to enter. Understand when it's time for you to step out. Always estimate what your potential to be able to make money is as compared to what your ability to take some loss is. And if you feel that your risk and reward capacities are good enough for you and you can tolerate whatever you see, then go ahead and execute the plan. Second, treat trading like it were a business. Remember, when you're buying a share of stock, you're actually buying ownership of a company. And you can't just be thinking that you're buying a piece of paper and throwing it away. You want to make sure that when you're buying a particular business, you see, you plan, you try to do some research, and you try to understand what strategy you want to use when you're buying your issue. When you come around to be able to devote a little bit of time to be able to do it, try to make sure that you remember you're building a discipline and you have to learn a little bit more about it. It might be tough in the beginning, but as you practice, as you come around to perfect what you have, you become an expert. You understand the pitfalls that may come off these particular situations, and you will learn and you will improve on your ways eventually. Always, always watch your capital. The amount of money that you have is what keeps you in this game. If you lose too much money and you don't follow too much the stringent requests of what the trading system does, you might find yourself with not too much capital left. And if you don't have much to be able to invest in the first place, you will not be able to even get in the investment strategy. And so try to be able to understand what you have from there. Lastly, try not to be able to get swayed by your emotion. I know we're human, and that means that we will have to be emotional every once in a while, but you cannot be emotional all the time. You always have to make sure that your strategy will be your fallback plan when things go sour. And always know that there will be moments where it's time for you to stop. If you try a trading strategy and at first you don't succeed, and the second time you don't succeed, and the third time you don't succeed, I would suggest on going on a trading break. That will give you time to be able to figure out what's been going on. If you're too close to the trade, sometimes it's very difficult for you guys to be able to unwind. So give yourself a little vacation, then reflect upon what you've been doing and seeing what you've been doing wrong, and try to come back with a little bit more insights on what it is that you have been doing wrong. And remember, when you come around to be able to rebound from a very difficult situation, remember you're going to have to take that first step over and over again. Don't get scared. If you understand what your strategy and your plan is, things should work out in good prospects for you. If you always are too panicky and you always are quite frightful of what is to happen, please remember scared money can never make good money. And the reason for that is because you will always be jumping out on first sign of trouble. And that is not the way a disciplined system works. If you're buying an uptrend and it shakes off a little bit, but it doesn't break through an uptrend line, stick with it. You should only be selling your position when areas of support are breaking. So try to be able to put all these particular insights back into place to be able to build on your particular trading system. You can combine the use of fundamental and technical analysis to be able to give yourself a very, very good chance of doing this quite successfully. By looking at the appropriate company to be able to buy, you will keep yourself in good quality issues that normally go much higher over time anyway. But if you don't use fundamental analysis to be able to qualify your picks, you could be buying a company that's not worth any money at all. And that could be quite a sour experience altogether. If you use the technical system to be able to get you in and out at the right amount of time, it should allow you to be able to generate much more income than you would if you were to just simply buy it once and hold it through and through. But remember, as you try to be able to take more activity in this, it becomes much more difficult to do. And that's why, of course, practicing this and perfecting it is very much what you have to be able to exercise as a discipline into it. All right, so that brings me to the end of my presentation. I would welcome any other questions that you might want to be able to pass on to me. And for those of you who've registered inside, that we could probably give you a copy of the presentations we have pretty soon. Thank you again for viewing, and I would take any questions that you have now. Okay, someone's asking, what type of trading software can you suggest without using COL's charting? Well, there are certain types of trading softwares that can actually look at charts, but if you want to be able to do this offline, you would probably have to be able to look for more professional services to do it. One of the companies that have been doing it for quite a while is called Metastock. You could probably find a software that they could use to be able to produce some type of graphing conditions as well. I would suggest looking at that, or you can also look at a lot of online sources that do produce certain things. If you want to look at graphs, you can actually use an online service called bigcharts.com. If you go into bigcharts.com, it is an online service that you can use. It's free. And if you want to look at a Philippine stock, you simply have to be able to put the prefix PH colon and then the stock symbol of the Philippine code that you're looking at. So, for example, if you want to look at PLDT, you would put PH colon then TEL, and then it should be able to show you the price of PLDT.